Okay, good morning, everyone. Please confirm me once in the chat if I'm audible. Okay, thank you. Now we are going to start our session. So what is the topic that we are going to discuss today? It is financial statements, right? Introduction to financial statements. I will be writing a lot of things here, so you should also make note of it. Everything that I write here, make a note. So what is the definition, or what do you understand by financial statements? What is financial statements? These are the documents which give us, or you can say these are the end products of financial accounting, which give us the informations about the company. Anil. So we have income statements. Then we have balance sheet. Third, we have cash flow statement. Fourth is statement of change in equity. And one more statement, that is other comprehensive income loss statement, right? And other than that, we also have notes to accounts. These are also statements only. So we will not talk about income statement first. So you have to write along with me. What is income statement? It shows the performance of company over a period of time. What is income statement? It shows the performance of company over a period of time. This time can be quarter, 6 months, 9 months, or complete financial year. This time can be anything, 3 to 6 months, 9 months, or complete 12 months. Indicate that means financial year. For example, now let's suppose we have sales of rupees 1000 and expenses are, let's suppose, 600. Then what does it mean? Profit of 400. My question is, what does this 1000 represent here? This 1000 represents the worth of product and services sold during this particular period for which this income statement is prepared. If the income statement is for 3 months, then this much rupees of product and services have been sold. It does not mean that this much cash has been collected. Cash collection can be more than this, or it can be less than this. So let's suppose cash received is 1200. Then what is 200? 200 is advance received. You are showing revenue of 1000. That means product and services have been given for 1000 only. but cash which you have received is 1200. So 200 is your advance received. Now let's suppose cash received is 800. In this case, what is 200? 200 is your accounts receivable. Right? So what is your expense, which is of 600 here? For this particular period, the expense were of 600. It again does not mean that we have paid cash of 600. Cash payment may be more than this, or it can be less than this. So cash paid is, let's suppose, 700. Then 100 is your advance payments. Means you have paid more than what you should pay, more than your expenses. Maybe these are your advance rent payment. These are your advance subscriptions payment. These are some payment for advance salary or something else. So this is an advance payment, right? Let's suppose cash payment is 500. In that case, 100 is your accounts payable. Payables. So when your sales is not cash, expenses are not in cash, then profit is also not cash. Income statement shows the profit and loss. It does not show the cash inflows and outflows. It shows profit and expenses, sales and expenses, and profit, which not necessarily the cash. Okay. Give me 15 minutes more and then you will understand what do we mean by this. The second statement is balance sheet. So what is balance sheet? It shows the financial position of company at one point of time or on a particular date. You can note it, then we will continue the discussion. Now, in the balance sheet, we have two parts. On the one side, we have liability, and on the other side, we have assets. Right now, we are only taking a brief discussion about all the three statements. We will have a detailed discussion of income statement, balance sheet, and cash flow. It will take roughly 3 hours only on income statement. Then 1 hour on balance sheet and 1 hour on cash flow statement. Right? As of now, in 2-3 minutes, we are just taking a basic introduction about what do we mean by financial statements. So liability can be divided into current liability and long-term liability, and then we have equity. Then in the asset side, we have current assets and we also have long-term assets. If you add them up, then you will get total liability and equity here and total assets here. These total assets and these total liability and equity should always be equal. Clear? So at on a particular date, how much assets were there in the company and how much liability was there in the company. This is what balance sheet shows. Balance sheet shows on a particular date how much was the liability, how much was the asset. Clear? Let's suppose under cash we have 100 crore of cash and the balance sheet is of 31st March. So it is on 31st March that the company had 100 crore of cash. On 30th March, it was different. On 1st April, it was different. But on 31st March, it was 100. So, but in case of income statement, here 1000 means the total revenue during that period of, let's say, 12 months. Till 31st March, from 1st April to 31st March, this much revenue was generated. These many expenses were incurred. This much profit was generated. Is that clear or not? Right? Then we have cash flow statement. It shows sources of cash and uses of cash over a period of time. It shows just another definition, which activities are consuming cash and which activities are generating cash over a period of time. Again, this time can be 3 months, 6 months, 9 or 12 months, right? So what are the activities? We have cash from operating activity, that is CFO, cash from operation. Then we have cash from, correct, investments. Yeah, investment activities. We call it CFI. Third is cash from financing. This is called CFF. Now let's suppose the operating cash was 300 during that period. 100 minus was investing activity, minus 150 was your financing activity. If you add them up, what will you get? Surplus or positive value surplus, negative value deficit. So company generated 300 rupees from the operating activities. From that cash, it invested into investments of 100 and 150 has gone into financing. Maybe dividend payment, interest payment, debt repayment, share buyback. These are the activities which come under financing activity. So out of 300, we still have managed to generate 50 crore of cash in surplus. So this is the cash which we have generated during this period. We will have some opening cash also in the balance sheet. Opening cash was, let's suppose, 200. So how much is the closing cash balance? It should be 250. So now this 250 will reflect in your balance sheet here, which we have written 100 here. It will be 250. Clear? Noted. This theory session will continue even tomorrow. There are 2 sessions specifically for financial statements, right? I am recording this session and the recorded will be given to you after the class. 4th statement is statement of changes in equity. And participants, if you have some question, please write in the chat. Don't send me personal WhatsApp. During the class, I will not say to it. मैं WhatsApp नहीं देखूंगा. ठीक है? So if you have any question, type in the chat. Chat in this Zoom only. Now, statement of change in equity. It shows which items are affecting the equity of company over a period of time. Let's suppose the equity in 2021 and 2022 was 100 and 250. So the equity has changed. Change in equity is how much? Plus 150. What is the source of that change? Equity has changed. So what items are affecting the equity of company? That you want to see. So that we can see from statement of change in equity. So like opening equity is 100. Closing equity is 200. So first we will have equity issue, equity buyback, profit will be added, dividend will be deducted, and option proceeds will be added. Minority interest, I'll discuss about it later. That will be added. Minority dividend will be deducted. And there may be some other items. Right? So this actually tells us what are the items which are affecting the equity. So if you are issuing equity, plus it. If you are buying your equity back, then minus. Profit of the company will be added. Dividend of the company will be deducted. So this basically is called retained earning. Option proceeds. Option amount that you receive after converting your ESOP into shares. That is option proceeds. Minority interest will be plus. Minority dividend will be minus. Now there can be some other item depending on the company. So that can be plus or minus depending on the company itself. Please note it. I'm just coming in 2 minutes. So far what we have discussed, we discussed that what is a financial statement, definition of it, what are the types of financial statement, and we discuss about every statement in just very brief in definition only, right? We took the definition of income statement, balance sheet, cash flow statement, and now we discuss the definition of statement of inequity. So it is time to start the detailed discussion on all the statements. So online, please confirm, have you written everything? Yes or no?
Sir, wait a minute, sir. Wait a minute.
Everyone online, please confirm in the chat. Okay. So let's now start with the income statement format. But before we start, let me tell you, this is just one format which I am discussing. Not necessarily that company will give you its information in that same format. Company can change its own format over a period of time. Previous year, there may be some items which are not there in current income statement. Clear? So with the format which I am going to write, we will simply understand what is an income statement. There may be few more or less items depending on the company, depending on the sector. Okay. So format of the income statement. So what is that? We have first, we have net sales. Then minus COGS. We will understand what all these things are. Just let me write down first all the items. We will have gross profit. After that, we are selling general and admin expenses. Then we may have other income or expenses. We may have or we may not have. Then we will get EBITDA minus depreciation amortization. We will get, what do we get now? EBIT. This EBIT can be called operating income minus interest expense. You will get earning before interest, tax, depreciation and amortization. We will get EBT. This is also called pre-tax income. Then current income tax, deferred income tax, equity income from associates, profit after tax before minority interest. This minority interest can be called non-controlling interest. It is same. Nowadays, non-controlling interest is more popular, right? Minus non-controlling interest or minority interest. Sir, why are you saying minority interest when non-controlling is more important? Because when we used to study minority. And this is the last time I'm using this word. After this, we will have the annual report. And in the annual report, we will have non-controlling interest. Clear? Now, instead of writing minority interest, they can also write PAT or profit attributable to non-controlling interest. So when it is written, you will understand everything that I have written here in the income statement may be written in different words. You have to understand what it is. After that, net income or net income after minority or net income attributable to ABC company, net income attributable to equity. It can be anything. Understand what is written and what is written before and after that. Then we have preference dividend, common dividend. We will get retained earnings. You have to learn this format and you have to write it couple of times on paper and revise it after 2-3 days. But you cannot afford to forget the format. And now I will explain every item. You should remember the explanation also. Here. So after retaining, what we'll have? Basic earning per share and diluted earning per share. Let's start with net sales. What is net sales? Total charge made to customers for selling goods and services. Let me copy this. You should also do it, but you are writing on paper, so you cannot copy. So what you should do, type net sales, write net sales and write the description like this. What is net sales? And now write the description which I'm going to write here. Okay. Above was income statement, but I will be writing a lot of things, so format will be disturbed. So I have to copy this. So total charge made to customer for selling goods and services during the period. So whatever products and services you have sold to your client customers, what is the worth of that? What is the billing? Clear? That is net sales. Now, if you get into the technicals of it, let's say gross sales minus sales returns, वो भी हो सकता है. So ultimately net sales. Gross minus sales returns and minus discount allowed, right? And minus one more thing. What is that? Purchase क्या होता है? Sales returns तो हो गया. Gross minus sales return minus discount allowed minus any excise duty, any tax that you have charged for that sales. So that will not be a part of your gross sale. Gross sale is the amount which the company will receive, not the amount which you are taking from the client in terms of taxation. The tax will directly go to the government. You are just collecting it. You will be paying it to the government. Okay. So it is not a part of your income statement. In income statement, what do you show? What belongs to your company, not what belongs to someone else. It cannot be your part of revenue. It cannot be a part of your expense. So any tax that you are collecting from your client on behalf of the government, so it cannot be part of your income statement. Why did I discuss this point specifically at this point of time? This was asked from one of my students in the interview. And we did not touch this point in the class. So he got confused. Right? Sure. Next is cost of goods sold. What is cost of goods sold? Total production cost, or let me write direct production cost. You can also write all expenses which are directly attributable to production of goods, and there is a specific statement that we prepare, that is cost sheet, and that cost sheet is actually used to find the cost of goods sold. I'll teach you that part also. Maybe tomorrow I will teach that. So direct expenses like raw material plus labor cost plus carries inwards the cost of bringing the raw material to the plant, that is carries inward. Carries outward, after that finished product is ready, you are distributing it, then it is carries outward. So carries outward will not be added here. Plus factory rent, power, fuel, factory manager salary, quality in charge, guard salary. Why I am writing all of this? Because I want to tell you something which is related to factory will be a part of cost of goods sold. Person sitting in the corporate office as HR, his salary is not included in COGS. But person involved in the production process in the factory, all those expenses, all his salary will be added here. right? Next, gross profit, and then we are selling general admin expenses. Here you will write indirect expenses. Indirect expenses like salary, office rent, advertisement, repair and maintenance, insurance. Now insurance can come here also. Insurance of machine used in production process will be here. Repair and maintenance of the machines used in factory will be added here. But this is for the office expenses, not the factory related expenses. Okay, so item name can be same, but it is a part of a different category. Clear? So we will report it added in a different expense item. So these are indirect expenses, and these are your direct expenses. Now, travel and allowance, fees and commissions. And then you can put depreciation here in SG&A or COGS also, but we have a separate item for that. But practically company can put these two items in COGS and SG&A and others also, and they do that. And it's not a very small percentage of company doing it. It's a large percentage of people doing it this way. They put depreciation and amortization within COGS and SG&A. They do that. So other office expenses. Here, like carriers outwards. Yes. Travel and allowances. Other expenses, those expenses which are not a part of COGS or SG&A, but they have incurred, so you will report them here. Like gain loss on asset sales. Restructuring, dividend, rent, interest incomes. You can put them here. Clear? But these are your incomes which you can put here. If they are expenses, then you know the place. If it is rent, it can go either in COGS or it can go in SG&A. If it is dividend outflow, then you will put it after profit here. And if it is interest expense, then you will show below EBIT. Right? Next is depreciation and amortization. Okay. Depreciation and amortization. What is depreciation? It is the systematic allocation of fixed assets during the useful life of the assets, fixed assets. So why do we charge depreciation? Depreciation is charged because we follow matching principle of accounting. And matching principle of accounting says match the benefits with the expenses. If you have purchased a machine for 50,000, which you are going to use for next 5 years. So the machine has been purchased today, 50,000 has been paid. So you are not supposed to show all the 50,000 expense in the current year of income statement as an expense. Because if you show in current year, in the next 4 years, there is no expense. But you will be taking benefit of that machine in next 4 years also. So you will not follow matching principle, right? In that way. But we are asked in the financial accounting that we should follow matching principle, so that cost of that machine will be allocated in next 5 years. Clear? Okay. So depreciation is charged on tangible fixed assets. What are tangible fixed assets? Like land we have, machines we have, fixtures, furnitures, 100 types of equipments. Anji? Plant. Yes, no, confirm karo na, sun. No, plant includes all of these things. Plant is not a particular item. It includes so many items within that. So land, machine, furniture, fixtures, equipments, fixtures, etc. Now, out of these items, land will not be depreciated. Land is not depreciated, as we have to follow, as land is a perpetual item, or land has perpetual or unlimited life. You can write it like this. So if you want to depreciate something, you should know the life of it. So when there is unlimited life, so we cannot depreciate it. Clear? Noted. Next item is amortization. Amortization is charged on intangibles. Intangibles, what are intangibles? Anything of economic value to the company without a physical substance. And what do we have in intangible? Trademark, patent, copyright, IPR, intellectual property rights, some kind of recipe, some kind of software, and goodwill. But goodwill is not depreciated. Rather, it is, sorry, goodwill is not amortized. Rather, it is tested for impairment at least once annually. What is charged on intangibles? Intangible, anything of converting without a physical substance. Examples of intangibles are trademark, patent, copyrights, IPR, software, goodwill. But goodwill is not amortized. Okay. Everything we have written. The next item is depletion. Depletion is charged on natural resources. Done. Okay. After this, what do we have? Depreciation. We have interest expense, and then we have current income and deferred income tax. So interest expense, if you take short-term loan, long-term loan, bond, commercial paper, or whatever, then you have to pay interest on that. During that period, whatever interest expense you have to pay. I'm not saying you have paid. The interest belongs to that particular period will be reported here, whether paid or not paid. So income statement will show all the incomes and all the expenses without considering the fact whether they are paid or whether they are not paid, whether the amount has been received or not received. You have to show all the incomes and all the expenses of this particular period. Clear? Next item, everyone has noted it. So the next item is current income tax and deferred income tax. So these two items, or let's say deferred tax item, is reported because of different accounting treatment of so many items between financial reporting and tax reporting. There are two types of reporting. One is financial reporting, another is income tax reporting. Financial reporting is governed by, or what should I say? It is prepared according to in Company Law 2013. Financial accounting is prepared according to Company Law 2013, whereas income tax reporting is prepared as per Income Tax Act 1961. Clear? So there are two different accounting rules. So due to different accounting issues, profit is different. When the profit is different, tax will be different. Tax is different. So whatever is the difference of these two taxes, that will be called deferred tax. Now it can be deferred tax liability or it can be deferred tax asset. It will depend on the plus sign or minus sign. As of now, clear? So now let's discuss this in Excel. It's difficult to explain on Notepad, so I am opening the Excel file. So one we have financial accounting, and then here we have income tax accounting. Financial accounting is based on Company Law 2013 and this is based on estimates, accrual accounting, and provisions. This is prepared for analysts or investors or management, whereas this is based on Income Tax Act 1961, and this is based on actual, or you can say cash. This is prepared to file ITR to government. Clear? Now let's suppose here your tax only, direct tax. Here it is shown as 120 and here we are showing 100. Because there are so many accounting that are involved above this item, right? So due to those different accounting treatment, we are having different taxes. 120 in financial accounting and 100 in income tax accounting. Clear? So you have to report this. This is what we will see. But in this, you are saying the tax liability is 120. But actually to the government, you are paying 100. So out of this 120, 100 is not paid today. Clear? So what is that 20 rupees? It is your deferred tax. So from this 120, you can report 120 directly. There is no issue. You can bifurcate it. Let's say 120. Now this 100 will be your current income tax. What it is called? Current. And this will be called deferred income tax liability. Clear? Now let's suppose I change the situation. This is 100 and this is 120. It is possible, right? Now in this case, what is what?
Current 120. Current 120.
No. $120 is your tax which you are paying to the government, but you will show -20 as your deferred tax asset. So if you want to show 100 only, it's okay, you can show that. But somewhere in other statements, you can find these two information, that how much tax we have actually paid to the government and how much is the deferred tax asset in that. So overall, it will be 100. Clear? Shall we proceed here? Note it. We will have one example. Okay. Now come here. One of the difference between financial reporting and tax reporting is because of depreciation. But depreciation is only one item. Okay. Using this depreciation, we will discuss how deferred tax is created. Now, how depreciation can be different into financial reporting and tax reporting? Because of method, because of life, because of rate. If any of these three things are different in financial reporting and tax reporting, then depreciation amount can be different. Come here. So let's suppose we have EBITDA of 1000, depreciation 400, then EBT will be 1000 minus 400. Tax will be this into 50%. Profit will be this minus this. Sorry. Clear? This is financial reporting that we are doing. Now in balance sheet, we have gross assets, of 1200. Accumulated depreciation is how much? 400. Net fixed assets will be this minus this. Okay. In the second year also, what is happening? 1000 of EBITDA, 400 of depreciation, EBT 600, tax 300, profit 300. In the balance sheet, gross asset will be 1200 only, but accumulated depreciation will be opening 400 plus 400 of current year. Then net will be 400. In the third year, 1000, 400, 600, 300, 300. In the balance sheet again 1200, and gross will be accumulated depreciation will be 400 because opening 800 plus 400 of current year. So net will be 0. In the fourth year, there is no asset. So EBITDA will be this and depreciation will be 0. EBIT will be, EBT will be 1000, tax will be 500, profit will be 500.
Sir,
This is what is happening in financial reporting. Bolo.
sir, final year में 410 में 1000 की EBIT.
क्या?
Final year में EBT 1000 की.
Because there is no depreciation, because there is no asset. Here, next we are going to talk about tax reporting. Yeah, income tax account. Items will be same. EBITDA no need to be same because there are so many items above it. But here we are discussing the reason for deferred tax because of depreciation only. So EBITDA is same. But it can be different in practice. Because above this we have sales, COGS, SDNA, and they are also different in financial reporting and tax reporting. Here I am considering depreciation of 600. Then profit will be this minus this. Why this depreciation is different? Because of any reason. Rate can be different, life can be different, method can be different. Now tax will be 50% of this, which is 200. Then profit will be this minus this. Clear? So gross assets 1200, depreciation will be 600. Net fixed will be this minus this. In second year, the same thing will continue. In balance sheet, what will happen? Opening 600 plus depreciation of current year. Then net will be 0. In third or fourth year, there is no asset. So what will happen here? Depreciation will be 0. There will be no depreciation in third, fourth year. So this is our tax reporting and this was our financial reporting. Let's look at the value in the first column of tax. It was showing tax of 300. How much you have paid to the government? Only 200. So the difference is deferred tax liability, and that is 300 minus this 200. So 200 is your deferred tax. Is this clear till now? So make note of it till now, and then further we will explain again. As of now, this much is okay. Do it. Okay. Now in the first column, in the first year, what will be our deferred tax? It will be tax in the financial reporting minus the tax in tax reporting. So this difference is deferred tax. It is coming positive, so it is deferred tax liability. Now opening deferred tax liability plus deferred tax liability of current year. So again this minus this. Previous year 100, 100 of this year, so total will be 200. Now look at third column. Here we are showing 300, but actually to the government we are paying 500. So first and second year of tax which you delayed, which you postponed, is actually paid in third year. Okay, so what will happen? 200 minus 200 of this year. So I will not write it like this, let it happen automatically. This minus this. In the fourth year, you are showing 500 here and 500 here. So there is no difference, so it will be 0. Here, not it. Okay. Now, if you look at the total tax paid in 4 years, how much is this? 1400 in financial reporting, and in tax reporting, here also it is 1400. So this will stand same in every situation. This cannot change. Right? However, actually what we had done, we had assumed our assets constant in the next 4 years. It will not be constant in next 4 years. And we created deferred tax just because of depreciation, and it will not be same. There will be many more items. Clear? But overall, what we say that over a period of time, total tax paid will be equal to the total tax paid in financial reporting and tax reporting. Okay. Now, just one more thing. At one point of time, there will, let's say, laptop, which will create deferred tax liability, and furniture will create deferred tax asset. Okay, it is very important. Please pay attention. In laptop, deferred tax liability is 150. Because of furniture, the deferred tax asset is 100. Now you will not report like deferred tax liability 50. Am I making sense? Overall, you can say that deferred tax liability is 50, but it's not the method you will report. You will report both. Because of laptop, deferred tax liability was 150. Because of furniture, deferred tax asset was 100. Deferred tax liability of laptop will be offset by the deferred tax asset going forward, maybe second year, third year, or fourth year. So it will be offset by that only, and it will become 0 over a period of time. The deferred tax asset of furniture will be offset by deferred tax liability of furniture only after some time, and it will become 0. And it is not that the whole 100 rupees will be offset in 1 year. Maybe in one second year, 60 rupees is offset, then 30 is offset, then 10 will be offset.
So, but in the case of financial statements, we have to report net of the both, not
You have to report both. On the face of financial statement, I can say that you can report one figure. You can report, it's okay. But in schedules, how that calculation has come of 50 rupees, you will show that. Reporting method, you can decide based on your personal preferences. There are some, what should I say, flexibility or permissions are given. You can decide that. But ultimately, you have to report both. Now, in first year, if I say this deferred tax is short term or long term, it is long term, madam, because it is offset in 2 years. So this is long term. In second year, this 200 is what? Short term, because it is offset in 1 year. But I'm talking about balance sheet. This will go in the balance sheet also. That obviously this part is balance sheet, because this is income statement. Okay, so I will report this in long term and this in short term. Now, was it possible that out of this 200, only 60 was offset here and 140 was offset here? It is possible. So in this column, 150, 140 will be long term and 60 will be short term. And here that long term amount in second year will become short term in third year. Did I make my point clear? If I had explained to you everything in Hindi, things would become easy. I know that. But there are few students in class who don't understand Hindi. So that's the reason I have to explain everything in English. I have given you the Hindi recorded videos also. Here, however you are getting it, I know that explanation in English will make the class little boring. But I'll bring 2 cups of tea for you again. You can enjoy that. One is already over. We can get one more. Fine. So let me make this clear once again. Deferred tax liability at a point in time can be short term and long term both. And deferred tax asset can be short term and long term both. So in a balance sheet, you can see all the 4 items. In current liability, short term deferred tax liability. In long term liability, long term deferred tax liability. In current asset, you can see short term deferred tax asset. In the long term asset, you can see long term deferred tax asset. Simple. But you can write only one item also on the face of the balance sheet. Details can be identified in the schedules. Shall we proceed now? Okay. This 300 rupees, you can write full amount, but you can bifurcate it. How? If you write 300, it's okay. But you can bifurcate 200 and 100 also. This 200 will become current income tax or provision. And this will be deferred tax liability or deferred tax asset depending on the item. In this case, it is deferred tax liability. Now this will be 300 will be income tax expense. Please note it. Okay. Now, what is the next item? The next item is equity income from associate and minority interest. And after that, the next item is earning per share. 3 items are left from the income statement. For discussing about equity income and minority, I'll again take you to Excel file. And here we will understand this. To understand this, we need to understand an important topic of corporate investments. So if one company invests in the other company, that is called intercorporate intercompany investment. It can be divided into 4 segments. One is minority passive investment, minority active investment, joint venture, controlling investments. Now let's suppose there is a company P, company S. Company P has invested in company S. Okay. Based on not just percentage, but other factors also, it will be decided what kind of investment it is. So if it invests 0 to 20%, it will be minority passive. 20% to 50%, it will be minority active investment. What is this 20%? When company P holds, let's say 20% equity in company S, then it will be called minority active. Clear? 50% each. Now what it will be called? Joint venture. More than 50% up to 100%. It will be called controlling. Now these percentages are not necessarily true. Okay. For example, if company has 40% stake in this, it can be minority active, right? But it can be joint venture also. The joint venture is of 40-60%, it is possible, right? Now you have, let's suppose 40% stake, it can be controlling also. Because you have 40%, remaining 60% is divided into 60 people. So everyone has 1 or 2% only. So who is actually controlling it? The person who is holding 40% stake. Right? Now, let's talk about this. It is very simple to understand. This can be divided into 3 categories. What are those? First is trading security. Second is hold to maturity. Third is available for sale security. Now, minority passive can be further divided into 3 categories. In which category this investment will be divided will depend on the objective of that investment. One company has invested in another company. What is the objective? Do you want to trade? Yes. So it will be called a trading security. Tata has acquired 10,000 shares of Asian Paint, and maybe it want to trade in the shares. After some time, it will sell it and make some profit. That is the objective. So it is called trading security. It can be hold to maturity. If you want to hold it till maturity, then it will be called hold to maturity. So hold to maturity cannot be shares. It can be bond, notes, commercial papers, right? So it can be debt only. But trading security can be both debt and equity, both. Now, third is available for sale. When the objective is not very clear to the company also, they invested it, maybe they will trade or maybe they will hold. So in that case, it will be called available for sale security. If they get a positive opportunity for making profit, they will sell it. Otherwise, they will hold it till maturity. It is called available for sale. Now, is this clear? Okay. So the percentages are not necessarily the right way to decide which type of investment it is, right? It is just a guidance that this is what should happen. Like if you have 60% stake, so it is definitely a controlling investment, but not necessary. So another important part which will decide what kind of category it is influence. Influence of company P in company S will actually decide whether it is minority active or it is joint venture or it is controlling. Okay. Now, in this case, what happens? Company P has significant stake, but it cannot influence too much, right? It has significant stake in this company, but it cannot influence too much. It has some influence, not too much. It cannot control the management. It cannot change the policies of the management, but it can ask questions. So it will be minority active. Company P and company Z together formed a new company called company S. It is a joint venture. So the situation is altogether different. Company P and company Z together formed a new company called company S. Company P has 40% stake. Company Z has, let's suppose, 60% stake. It is a joint venture. So that will be the situation. Now, company P started a new company, company S, which is a subsidiary of company P. Now, further investment was required. Company P was not capable of it. So investment was taken from company Z or many other companies. But still company S is a subsidiary of company P. So controlling investment. Did I make my point clear? Hello. So if this is the situation, we will use equity method accounting. If this is the situation, we will use proportionate method of accounting. And if it is this, then we will use consolidation method of accounting. Please note it. So now we will take one example on these three things. So we have one company P. We have one company S. Sales is 1000. Expenses 600. Profit. This minus this. Company P, company S, company Y, company H. Okay. Company P is the parent company, main company, right? Company P has, let's suppose, 60%. Okay. 30% stake here. And this is a joint venture with some another company. Company ABC. This company is a joint venture between company P and company ABC. So, and here company P has, let's suppose, 50% stake. And in this we have 70% stake. Okay. Now, clear? We have to prepare one consolidated income statement of company P. Right now, in this case, I will be using equity method. Here, proportionate method. And here, we can call it controlling consolidation also, or simply consolidation, right? In this case, what I'll do, I will only take the profit of company S and add it to company P, and that will be called equity income from associate. Here we don't have much influence. We have some influence, but not too much.
Sir, so associates क्या होते हैं? जैसे कि associates तो वो नहीं होता है कि analyst और फिर उसके बाद ऐसे।
अरे वो डेजिग्नेशन है, एसोसिएट तो एसोसिएट्स होते हैं हमारे साथी।
और इसमें associates
ये कंपनी है, एक ही चीज को दो जगह यूज नहीं कर सकते क्या? So associate here means not some analyst, senior analyst, associate, team leader. I'm not talking about that associate. Here it is a company. This is one parent company and this is the associate company of this parent company. That's it. Now, this is a joint venture company. This is a subsidiary company. Now, कहाँ से कहाँ connect किया आपने? मैं अभी तक वहीं पे हूँ. Okay. So in this case, I will use equity method. I will simply add the profit of company S into P, and that will be called equity income from associate. In case of joint venture, 50% of sales and 50% of expenses will be added to company P. So sales 50%, expense 50%, automatically 50% profit added. Clear? In this case, what I will have to do? All the sales will be added to company P. All the expenses of company will be added to company P. I'm talking about company H. Company H sales will be added to company P. Company H expenses will be added to company P. That profit is also added, which is not owned by company P. How much is that? 30% of this, because you own only 70%. So you will deduct that 30%, and that will be called minority interest. I need to explain in Hindi now. Okay. इस केस में क्या करोगे? सामने वाली कंपनी के प्रॉफिट का 30% अपने में जोड़ दो, वो उसको क्या कहेंगे? इक्विटी इनकम फ्रॉम एसोसिएट. ज्वाइंट वेंचर में क्या करोगे, 50% सेल जोड़ दो, 50% एक्सपेंस जोड़ दो, अपने आप ही 50% प्रॉफिट जुड़ गया। इस केस में क्या करना है, सारी सेल जोड़ दो, सारे एक्सपेंस जोड़ दो, वो प्रॉफिट भी जुड़ गया जो आपका नहीं है, ठीक है, उसको नीचे माइनस कर दो, उसको क्या कहेंगे, माइनॉरिटी इंटरेस्ट। क्लियर? Everyone has to comment in the chat if you have understood. वो सब्सिडरी है, इसलिए सब्सिडरी के केस में ट्रीटमेंट यही होता है। In case of subsidiary, we add all the sales and all the expenses, even if we don't own 100% stake in the company. Okay. Now, sales. When I'm preparing consolidated income statement, I'll take all sales from my own company plus this sales. How much? Only 50%. If the percentage is 40, I'll add only 40. If the percentage is 60, I will add 60. But in this case, it is 50, so I'm adding 50. Plus this sales will be total. 100% sales will be added. Clear? Expenses, consolidated expenses. My own expenses fully plus from joint venture, how much? This into 50 and H 100. Is this part clear to everyone? Yes. कौन बोल रहा है? Okay. Now what do we have to do? We have not added anything from here. So that we have to add, and we will call it equity income from associate or just equity income. That will be equal to profit of this into 30%. Right? Now calculate profit after tax before minority interest. How much is that? This minus this plus this. This is the company's total profit. But that includes that profit also, which does not belong to the parent company. So that you should deduct here. Minority interest. People will read it minimum interest. Minority interest. How much is that? Equal to company H profit. We have added it fully. 100% of it added to our income statement. So into 30%. This 30% should be deducted. So now this is net income after minority. How much is that? This minus this. Is that clear now? Kindly remember this simple exercise till the last of this particular program, because this minority interest will come in every class, and this equity income will also come. Let it be DCF, relative, M&A, everywhere minority interest will play an important role. So you cannot afford to forget it. Okay. Please make notes.
So, अगर एक client बैकअप अपनी सर्विसेज अलग अलग कंपनी से लेते हैं, थोड़ी बहुत सर्विसेज, जैसे कि एक कंपनी की जो लेंडिंग में वो लोन वगैरह में चाहिए तो एक बैंक ने उससे अपने अंडर ले लिया, फिर कुछ म्यूचुअल फंड्स में थी तो उसने अपने अंडर ले लिया।
फिर से बोलोगे?
एक कंपनी है, एक मेन कंपनी है जो बैंक, ठीक है, for example,
इन्वेस्टमेंट बैंक है,
नहीं कोई
अच्छा
भी बैंक,
कमर्शियल बैंक है, ठीक है।
तो उसने मतलब वो कुछ ऑपरेशन में अच्छा नहीं था, तो जिस ऑपरेशन में और कंपनी खुल रही थी उसने अपने अंडर ले लिया वो, ठीक है। तो ये जॉइंट वेंचर होगा कि साथ में उन्होंने मिलके काम कर लिया, या फिर ऐसे ही अलग अलग कंपनी में अलग अलग चीजें सभी हमने पढ़ा है इससे।
छोड़ दो, थ्योरी पे आ जाओ। When we are talking this, we will not talk about that. When we will talk about that, we will not talk about this.
मेरे
सुन लो, कॉन्टेक्स्ट पे बात करते हैं। एक कंपनी है एशियन पेंट, it invested in another company and acquired 25% stake of that. So now that another company, whatever profit that company will generate, that will give 25% profit to Asian Paint. IB Institute, invest in an institute in Gurgaon. I am not purchasing the entire institute in Gurgaon. I am simply having some stake in that institute. So whatever profit that Gurgaon institute will generate in that in the year, I will get 25% of it. Simple. Now I joined hand with someone in Noida and started a new institute there in joint venture. We have 50% stake each. So whatever profit of that particular institute in Noida will generate, I will get 50 and that institute will get 50. Simple. Now I went to Faridabad and there I started my own institute, second branch. Maybe a digital marketing institute, separate system. Now the entire institute is my own institute. It is my subsidiary. I will have the entire profit. Now if someone invests in that, let's say 20%, I will have only 80 and he will have only 20. अब now clear? ठीक, सब लोग सुन लो दोबारा हिंदी में। IB इंस्टीट्यूट है दिल्ली, गुड़गांव में कोई इंस्टीट्यूट है जो चल रहा है, गुड़गांव वाले इंस्टीट्यूट को कुछ पैसे की जरूरत थी, मैंने उसको 10 लाख रुपए दे दिए और 30% स्टेक ले लिया। हमारी बात हुई कि भाई जितना भी तुम प्रॉफिट कमाओगे उसका 30% मैं लूंगा। ठीक है, सिंपल बात हो गई। मैंने 10 लाख रुपए दे दिए। अब जब तक मेरे 10 लाख रुपए मुझे वापस नहीं मिलते तब तक 30% का हकदार हूं मैं। अब जितना प्रॉफिट कमाएगा उसका 30%। अब उसने 1 करोड़ कमा लिया तो 1 साल में मेरे को कितना मिल गया? 30%, यानी कि 30 लाख रुपए। मेरे 10 लाख रुपए जो इन्वेस्ट किए तो वो नहीं मिले मुझे। वो चाहे तो मेरे वो 10 लाख रुपए वापस कर सकता है, फिर उसके बाद 30 नहीं मिलेगा। समझ गए? अब मैं और कोई दूसरा इंस्टीट्यूट मिल करके नोएडा में चले गए और एक वहां पे डिजिटल मार्केटिंग का इंस्टीट्यूट खोल दिया। वो तीसरा इंस्टीट्यूट है। मेरा इंस्टीट्यूट IB इंस्टीट्यूट और एक कोई पानीपत का इंस्टीट्यूट है, हम दोनों ने नोएडा में खोल लिया मिलके 50% का स्टेक। तो जो नोएडा वाला इंस्टीट्यूट है जितना भी कमाएगा 50 मेरा 50 उसका, ऐसा ही तो होगा। अब मैं गया फरीदाबाद, मैंने वहां पे एक इंस्टीट्यूट खोल दिया तो सारा प्रॉफिट मेरा ही तो होगा ना। अब उसमें 20% मान लो किसी और ने स्टेक खरीद लिया, क्योंकि मेरे पास पैसे इतने थे नहीं, मैंने किसी और से ले लिए और नोएडा वाले फरीदाबाद वाले में इन्वेस्ट करा लिया। तो क्या होगा? फरीदाबाद वाला जितना भी कमाएगा उसका 80 मेरा, 20 उसका। क्लियर? अब सुनिए, लिसन टू मी। In this case, 5 income statements are being prepared. Stand alone income statement of all the 4 companies and consolidated income statement of company P. Clear? Now here in this case there was one another company called ABC with which we started this joint venture. Now this company ABC will also prepare 2 income statement. One is income statement of ABC only and a combined consolidated income statement with this joint venture. It will have to prepare, right or wrong? Okay, because it has other investors who want to see the entire performance of company ABC. But here we are talking about company P, so with reference only we have prepared this. Now leave it, we are starting with the diluted EPS and basic EPS. Shall we start? Diluted EPS will take time, roughly around 45 minutes. So let's take 5 to 10 minutes of break now. Okay. So we are going for a break for 10 minutes. Okay, shall we start now? Let's go profit before minority interest is 120. Okay. Minority interest is 20 only. So net income after minority, net income attributable to company, net income attributable to equity. How much is that? 100. Preference dividend. Common dividend. Minority dividend. Preference is, let's suppose 10 rupees. Common is 20. Minority is 5. Tell me how much is the retained earnings. Retained earning would be 70. Why? Because minority interest, minority dividend will not be deducted. It is a part of this minority interest. So let's suppose if I write salary here, taxes, rent, will you deduct that also? That has already been deducted. That's the reason we got profit, right? So this minority dividend has already been deducted. After that only we got net income after minority. So I have written it just to explain you that it will not be deducted again, right? Next. Now there are two types of EPS. We will first talk about basic earning per share. It shows how much common equity shareholders are earning on per weighted average share basis. So basic EPS is equal to net income attributable to common equity divided by basic weighted average shares outstanding. So how much is our net income? 100 minus, okay. So net income minus preference dividend divided by ये होगा ना, ठीक है। अब देखिए preference dividend, why we have deducted? Because it is a preference dividend. When we are calculating earning per share, we are calculating on from the perspective of common equity, not total equity. Total equity includes preference equity also. So we are calculating earning per share from common equity perspective. So the amount which we have to pay to preference shareholders as preference dividend, that has to be deducted. So after that amount, whatever is left, that is left for common equity. Net income was 100 minus preference dividend, that is 10, divided by basic weighted average shares. For that we need some share related data. Okay, and for now I am assuming it is 150. I'll let you know how that is calculated. Give me a few minutes. So if we have, let's suppose 150 shares weighted average, I'll take 90 divided by 150, and that will give me 0.6 basic EPS. So that means on every one share, we are earning 0.6 rupees annually. It can be quarter also, 6 months also, but we are considering an annual income statement. So annually on per share basis, we are earning 0.6 rupees. Clear? Noted. Now I will explain you how this 150 is actually calculated. First, not everything that we have written here. Okay. Opening shares on 1st Jan 2022 was 100. Shares issued on 30th June 100. These are shares which are issued, new issue. Then closing shares on 31st December 2022 are 200. Yes, 200. So now these shares remained outstanding for 12 months, and these shares remained outstanding for 6 months. I cannot take 100 and I cannot take 200 for calculating my earning per share. I want to take on an average, on a monthly basis, how many shares were outstanding. So look, 100 into 12 plus 100 into 6, and that divided by 12. Now this will actually give me 150 basic weighted average shares. On an average throughout the year, how many shares were outstanding? That was 150. So this 150 will be taken here, and then net income will be divided, and we will get our earning per share. Noted. Done. Next is diluted earning per share. It is the minimum EPS the company would generate after considering the dilution effect of dilutive securities. There are certain dilutive securities. What are those? We have options, warrants, convertible debt, convertible preference stock. If these securities are converted to equity, our share base will increase. Then what will be our diluted? Then what will be our EPS? Am I making point clear? I am saying if these securities can be converted to common equity, if they want to convert, right? If they are converted, then what will be the EPS? That EPS is called minimum EPS. Yeah. So diluted earning per share is equal to net income attributable to common equity after dilutions divided by what? This time we will take diluted weighted average shares outstanding. Okay. Then net income. Look, if convertible preference stock are converted to common equity, so that preference dividend which we were giving will not be paid. If preference stock is converted to common equity, when preference stock is not there, then preference dividend will also not be there. So what we were deducting in basic EPS, that preference dividend, that will not be deducted now. Making sense? Okay. Next, if convertible debt is converted to common equity, the interest which is paid on convertible debt will not be paid. So profit has come after deduction of that interest. So that has to be added. So what should I do? Plus interest on convertible debt. Now, listen very carefully. If that interest is 10 rupees, okay, that will increase my profit. Then I will have to pay more tax. How much? If the tax rate is 40%, I will have to pay 4 more tax. So finally, how much profit is increasing? 6. Profit is increasing by 10, but due to tax, 4 is decreasing. So actually, how much net income is increasing? 6 rupees. So let me make it clear once again. If convertible debt is converted to common equity, the interest which is paid on convertible debt will not be paid. That has to be added back. If the interest is 10 rupees, what will happen? Profit before tax will increase by 10. I will have to pay 4 more rupees of tax. So 10 rupees PBT increased, but tax is increased by 4. So net income is increased by 6 rupees. So rather than writing it like add interest 10 minus rupees 4 of tax, I will directly take interest post tax. Okay. What I will write here? 1 minus tax rate. ऐसा नहीं करते हैं कि भाई ये पहले आप 10 रुपए इंटरेस्ट बढ़ा दो फिर 4 रुपए टैक्स घटा दो. मैं 10 रुपए को सीधा पोस्ट टैक्स कर दूंगा तो सीधा 6 रुपए आ जाएगा. What I'm saying here, one way is to add 10 rupees minus 4 rupees of tax, you will get 6 rupees. Another way is take this 10 rupees and make it post tax, like 1 minus 40%. So what will happen? 10 into 60%, that will give you 6. So this is one way and this is another way. Which one is more prevalent? This one, this second method. Clear? So I'm deleting this part. Divide by. Divide by what? Basic weighted average shares plus dilutions. What is dilution here? Dilutions are new shares issued. New shares to be issued on conversion of dilutive securities. If these securities are converted to equity, then how many shares will be added? That is called dilutions. Clear? Now, net income is how much? 100. How much interest we should add? Let's say 15. Assumed figure hai. These are just random figures into 1 minus 40% of tax rate divided by basic weighted average shares 150 we have taken from above, and I am assuming that this will be 50. What is this 50? New shares issued against dilutive securities, that is 50. So 109 divided by 200, 0.545 is the diluted EPS. 0.545 is the minimum EPS the company would generate if diluted securities are converted to common equity. Done? लिखिए. ऑनलाइन में सब लोग लिख रहे हैं? इन ऑनलाइन एवरीवन राइटिंग? Yes or no? So confirm in the chat when you have noted it. Type done in the chat when you have written.
सर
Yes.
हेलो सर एक बार शॉर्ट में हिंदी में सॉरी सर एक बार शॉर्ट में हिंदी में वापस समझा दीजिए ना.
ठीक है. डायल्यूटेड ईपीएस या बेसिक ईपीएस भी?
सर डायल्यूटेड
डायल्यूट ओनली. देखिए डायल्यूटेड ईपीएस क्या है? डायल्यूटेड ईपीएस है कि आप कंपनी जो है मिनिमम ईपीएस कितना जनरेट करेगी अगर ये डायल्यूटेड सिक्योरिटीज कॉमन इक्विटी में कन्वर्ट हो जाए तो डायल्यूटेड सिक्योरिटीज क्या है? ऑप्शंस, वारंट्स, कन्वर्टेबल डेट, प्रेफरेंस स्टॉक। अगर इनको कन्वर्ट कर दें तो ईपीएस कितनी होगी? ये होती है डायल्यूटेड ईपीएस। तो फॉर्मूला क्या बनाया? नेट इनकम एट्रीब्यूटेबल टू कॉमन इक्विटी। ये तो बेसिक ईपीएस वाला ही हो गया, बट यहाँ पे क्या लिख दिया? आफ्टर डायल्यूशन। मतलब इनको कन्वर्ट कर देने से मेरा नेट इनकम कितना होगा, ठीक है? डिवाइडेड बाय डायल्यूटेड वेटेड एवरेज शेयर्स। अब इस डायल्यूटेड वेटेड एवरेज शेयर्स में हमने बेसिक शेयर्स जो ऊपर वाले थे वो तो लेने ही लेने हैं, प्लस जो नए शेयर्स इशू होंगे इनके बदले में, उनको लेने के बाद कितने शेयर्स होंगे उनको लेना है। तो ऊपर क्या लेना है? नेट इनकम आफ्टर डायल्यूशन, और नीचे क्या लेना है? डायल्यूटेड शेयर्स इंक्लूडिंग डायल्यूशंस। ठीक है, अब आते हैं यहाँ पे। तो नेट इनकम तो जो है वो लेनी ही है। अब बाकी के इफेक्ट डाल रहे हैं, किस किस के? इनके कन्वर्ट होने के। तो अगर कन्वर्टेबल प्रेफरेंस स्टॉक कन्वर्ट हुआ तो प्रेफरेंस डिविडेंड नहीं देना, नहीं देना तो नहीं लिखना। ऊपर क्या किया था हमने? हाँ, ये देखो यहाँ पे 10 रुपए माइनस किए थे, तो अब ये क्योंकि कन्वर्ट हो गए अगर, तो फिर नहीं कन्वर्ट हो जाएंगे तो हमें माइनस नहीं करना। लेकिन एक आइटम है जो हमने ऐड कर दिया, वो क्या है? कन्वर्टेबल डेट का इंटरेस्ट। तो अगर कन्वर्टेबल डेट कन्वर्ट हुआ तो इस पर जो इंटरेस्ट है वो हमें ऐड बैक करना पड़ेगा। लेकिन अगर इंटरेस्ट ऐड बैक किया तो टैक्स ज्यादा पे करना पड़ेगा, तो हम इंटरेस्ट को पोस्ट टैक्स ऐड करेंगे। डिवाइड बाय क्या किया? बेसिक शेयर्स जो पहले के थे वो, प्लस डाइल्यूशंस। डाइल्यूशन क्या? इनके कन्वर्ट होने से कितने शेयर्स देने पड़ेंगे, वो मान लिया कि 50 है। तो 100 तो पहले की इनकम जो थी, प्लस 15 जो इंटरेस्ट है कन्वर्टेबल डेट पे, बट टैक्स देना पड़ेगा 6 रुपए। अगर 15 रुपए इंटरेस्ट आपने ऐड किया तो 6 रुपए टैक्स पे करना पड़ेगा। तो हमने इसको पोस्ट टैक्स करके डायरेक्टली 9 कर लिया, तो ये 109 हो गया। डिवाइड बाय इतने शेयर पहले के ही थे, इनको कन्वर्ट कर दिया तो 50 और देने पड़ेंगे, तो 200 हो गए शेयर्स हमारे। ऊपर नेट इनकम थोड़ी सी बढ़ी है, नीचे शेयर्स भी थोड़े से बढ़े हैं, ओवरऑल हमारी अर्निंग पर शेयर घट गई है। इसी को निकालना चाहते थे कि अगर डाइल्यूटेड सिक्योरिटीज कन्वर्ट हो जाएं तो हमारी ईपीएस कम से कम कितनी होगी। अब यहां पर लेट मी टॉक इन इंग्लिश नाउ, व्हाट आई वांटेड टू टेल। Yes, I wanted to say the diluted securities have actually not converted. We are just assuming if they are converted, then what will be our earning per share? If it is actually converted, then it will not affect diluted EPS. It will first affect my basic EPS. If they are actually converted, then we will have to issue shares. We will have to actually issue shares, maybe in June, in July or September, whenever. Shares will be issued and it will affect my basic earning per share. And then I will not consider those securities which have actually converted in my diluted EPS. While calculating in my diluted earning per share, I consider those securities which have not been converted. I don't consider those securities which have actually converted. Making sense? Okay. Last sentence. Securities which have actually converted, I will consider them in basic EPS. Securities which have not yet converted, I will consider them in my diluted EPS. Now is it clear? Okay.
You are just estimating the diluted EPS.
Yes. Now, point is, how do we calculate this 50? Yeah. Someone wanted to explain me in Hindi. Have you understood that? We are want to understand this 50. So what we have here? Options we have. And we have 100 options. What is the strike price? The strike price is 40. And market price is 50. What will be the dilution? Now, what is the strike price? The price at which these options will be converted into shares is called strike price or exercise price. This strike price should be less than market price. Only then options will be converted. If the strike price is 60, why would anyone want to buy shares at 60 when the shares are available at 50 in the market? Company will have to give at this price. If the strike price is less than market price, then only I will benefit. Otherwise, I will not benefit, right? So 100 shares will be issued. Company will get 100 into 40 rupees. What amount company will get? 4,000. We are assuming that this amount will be used to buy shares at 50 rupees. Company is issuing 100 shares. Company will get 100 into 40 rupees from those employees. This amount 4,000 will be used to buy shares at market price. So what will happen? 100 shares will be issued and 80 will be bought back. So net shares will be 20. This is your dilution. This is called option dilution. This method is called treasury stock method. Then next what we have? Method for options and warrants is same. We will use only treasury stock method. TSM, treasury stock method, says cash received from option conversion will be used to buy back shares to reduce the dilution. If you don't buy back your own shares, you will end up issuing 100 shares. The EPS will go down drastically. Is it clear? And we don't want that. So whatever cash will be used, whatever cash will be received, we assume that we will use it to buy back shares. So net effect on our earning per share will be because of 20 shares only, not because of 100 shares. Okay. Then we have convertible debt. Strike price, market price. Debt is 41,540. Strike price is 15. Market price is 50. In this case, the company says we have a loan of 450 rupees. This can be used to convert at equity at 15 rupees each. This is again in the money. Strike price is less than the market price. We call it in the money. Okay. So dilution will be like 450 divided by 15. How many shares we will have to issue? 30. This is your debt dilution. In this case, we are not buying back. Why? Because this was not unit. This was your debt. We have already used this cash to purchase land, machine, advertisement, salary payment for whatever purposes. In this case, this amount was additional amount. Okay, then we had to take the net effect. Here in this case, this is not additional amount. Amount taken as debt and used in the business. We are now converting it to shares. So 30 shares will be issued. So these are your option dilution 20. These are your debt dilution 30. Total becomes 50. So in this calculation of diluted EPS, this 50 has come from there. Clear? So this method is called if converted method. If convert method is applied to convertible debt and convertible preference stock. Yeah.
I have a doubt.
Excuse me, sir. Yeah.
Yes, tell me online.
Yes, sir. Sir, can you please explain what is strike price?
Strike price is the price at which shares will be issued to you. The
Okay.
market price of share is 50 rupees. But at this particular price, you can purchase the shares from the company.
Okay, sir. Thank you, sir.
Strike price is also called exercise price.
सर जैसे इन्होंने 80 रुपीज मतलब जो 80 आया है उन्होंने अपने एम्प्लॉइज या जो भी ऑप्शन उनको दिए थे उन्होंने शेयर खरीद लिए थे तो उसके बाद जो हमने बायबैक किया उनसे ही करें कि हमने मार्केट से बायबैक किया.
Okay. Now the question is, we are buying our shares. From where we are buying the shares? From the employees whom we have issued shares or from the stock market? Neither shares are issued nor we are buying back. Are you actually doing something? No. We are calculating the diluted EPS. We have not issued, we have not purchased back. It is just a calculation that we want to do. That if in case this is what happens, then what will we do? Now we have to buy shares either from you or from someone else. We want to take the net effect. On one side, I am getting rupees 80. On one side, I am paying 100. So net effect is on 20 rupees. Now your question is from whom I am taking 100 or from whom I am taking 80 and to whom I am paying 100. How does it matter? To me, the effect is 20. Got my point? पिछले 45 मिनट से हम कर क्या रहे हैं? ये हो ही नहीं रहा है जो हम कर रहे हैं. This is diluted EPS. Have you heard about PE ratio? In that PE ratio, which EPS we are considering? Basic or diluted? Diluted, not basic. Okay. 15 minutes more and then this EPS discussion will be over. Why we are calculating diluted EPS? That is the question. What are anti-dilutive securities? What will be the effect of bonus share, stock split, and share buyback on EPS? Want to discuss? Okay. What is left? Clear this now? Anti-dilutive securities. Second, Why diluted EPS? Effect of bonus split and one more. क्या था एक और बोला था मैं अभी?
EPS.
Buyback. So let's discuss first while diluted EPS. Let's suppose I came to your company. You told me your basic earning per share is how much? 10 rupees. On per share basis, your earning per share is 10. I got very happy and I said that, okay, I'll pay you 50 rupees for each share. I will pay you 50 rupees for each share. So for every 1 rupee of earning, how much I am paying? That is 5. Clear? Now, when I decided to purchase your company to acquire 100% of your equity, what happened? There were many people in the company who had diluted securities. They tendered them. Earning per share, which was 10 earlier, now has come down to 6. How much I am offering for every share? 50. So with this, how much I will have to pay for 1 rupee of earning? 8.33. Earlier, the deal was very lucrative. It was cheaper for me. But after actual impact, the deal is very costly. So I will take my judgment, take my decision based on this, not based on this. So I will consider this, not this. Did you get my point? Why I calculated all of this? Yes or no? ऑनलाइन वाले आप बताओ, क्लास वाले तो कोई नहीं बोल रहा. थोड़ा थोड़ा बोलते हैं. 4 बार पूछता हूँ तब 6 बच्चों के जवाब आते हैं. ठीक है, तान्या सेज यस. सब लोग नोट करो. ओके अभिषेक. Okay, everyone online, note it. Next, we have to discuss anti-dilutive securities. Okay. Why we need, what are anti-dilutive securities? See, diluted EPS. First, I am considering the effect of preference stock. In case of basic EPS, you were deducting preference dividend, which was -10. But in diluted EPS, we did not deduct it. So net effect is plus 10. If we issue only, let's suppose 9 shares for those preference stock, what will be the effect on my EPS? It will increase or it will decrease? Look at the net effect. Numerator is plus 10, denominator is plus 9. It will increase my EPS. So that convertible preference stock, it is not dilutive. It is anti-dilutive. Because instead of decreasing my earning per share, it has increased my earning per share. If it has increased my earning per share, it means it is benefiting the company, not the security holder, not the convertible debt holder, right? So why convertible debt holder will convert it? He will not convert. So when he will not convert, this will not be converted and there will be no effect. What will we do? We will deduct in the numerator minus 10 and in the denominator nothing will be added. So we will treat it as basic earning per share only. We will treat it like we treated it in basic EPS because it is anti-dilutive. Did I make my point clear? Okay. What is the next item? Sorry, I used the wrong word. We were talking about convertible preference stock. We discussed that convertible debt. Convertible preference stockholder will not convert its preference stock if it is anti-dilutive. Simple. And when it will not be converted, we will treat it like we treated in basic EPS calculation. So treatment in basic and diluted EPS will remain same for convertible preference stock, right? Next, what is next? Diluted EPS. We are now talking about convertible debt. So what was the effect? We added post-tax interest in the numerator, that was plus 9. In the denominator, if it is, let's say, plus 8 or 8.9, till this time what will happen? Earning per share will increase, it will not decrease. So if it will not decrease, we will not consider the treatment of it in the diluted EPS. We will treat it like we treated in basic EPS. If it is anti-dilutive, it will not be converted. So what we will do? Nothing in the numerator and nothing in the denominator. Why nothing in the numerator? Because we were adding it. Now we will not add it. So nothing will come. If that is not even converted, nothing will come in the denominator also. Because of this convertible debt. Next is options and warrants. If they, okay, final point. There are three situations: strike price less than market price. This is called in the money. Strike price equal to market price. This is called at the money. Strike price greater than market price. This is called out of the money, right? Only in this situation, option will be converted and it will be dilutive. In this situation, it will be anti-dilutive. Why? In this case, you will, let's say, issue 100 shares, but you will end up buying 120 shares. Why? Let's suppose strike price is 60 and market price is 50, what will happen? You can buy more shares than the shares you are issuing. So earning per share will increase instead of decreasing. So this is anti-dilutive situation and this is dilutive situation. Note करिए. Clear? The final effect discussion that we have to do for EPS is the effect of bonus, split and buyback. So buyback is very simple. Take a second. You remember we discussed this? Opening shares, share issued and closing shares, right? Let's suppose in September month, we buy some shares, 50, then it minus 50 into 3, right or wrong? Let's suppose on 30th September, if we buy 50 shares, so October, November, December, 3 months are remaining. So 50 into 3 with minus sign. That's the effect of buyback. Done? Okay. Let me remove this. This part is over. Let's assume that these are your bonus share as bonus shares. Then instead of multiplying this with 6, I'll multiply it with 12. Assuming shares were issued on this, it was an accounting treatment. We will consider these shares issued from the beginning only. Okay. Is this part clear? Yes. Next. So let me remove this. Let's suppose here somewhere in September, stock split was done into 1:2 ratio. So which stocks have been split? These stocks and also these stocks. I'm not considering in this situation these shares as bonus share. I'm considering them as shares issued against something else, but not as bonus share. So stock split has been done in 1:2 ratio. So these shares will be 200 and these share will also be 200. So instead of taking it as 100, I'll multiply with 200 and this also with 200. Is that point clear? देखो स्टॉक स्प्लिट में क्या होता है, एग्जिस्टिंग शेयर्स को ही डबल कर दिया है. तो ये वाले शेयर्स ही तो थे जो 100 थे, इन्हीं को तो 200 कर दिया, स्प्लिट कर दिया ना. ये वाले शेयर थे, इनको भी स्प्लिट कर दिया. क्लियर? Now we can have multiple different type of exercises on this. For example, some buyback happened here, some buyback happened after September, or some shares have been issued after September. Then accordingly, some adjustment will be made. But overall concept I have explained to you. With this, our income statement ends. Okay, this recording I'll give you. The topic for tomorrow discussion. The first part is cost sheet. Okay, we will discuss that. Balance sheet and cash flow statement formats and balance sheet consolidation like we did today for income statement. Okay. Stock based compensation we will discuss tomorrow and other things. Others में कुछ भी हो सकता है. ठीक है. If you can do it, watch the videos before coming to the class, recorded of the previous classes. You can watch them, or just directly come to the class. You will understand it. When you go back home, then practice. Okay. Whatever we have studied today, try to go through it using notes. अब ये तो 2.5 घंटे क्लास हो गई है. It was around 2.5 hours of session. Total 3 hours, but a part has not been recorded. That waiting time. So no need to go through this video. Just go through the notes which you have made in the class. That will be sufficient. How much time will you take to revise through notes? 30 minutes max. The format of income statement, the definition of financial statements, and some basic numericals. 30 minutes is sufficient to revise today's session. Tomorrow's session will again, you will take 3 hours in the class and 1 hour of session, 1 hour of time to revise the concepts. 1.5 hours. And how much hour I am asking you to spend weekly? Okay, on a daily basis, 1.5 hours maximum. No need to study for 5 hours. Just spend 1.5 hours to revise the topics and to study in advance. And that is much more than sufficient than what I want. The problem is you are not spending time on it. How many of you actually watched the videos on financial statement? देखी थी दोनों ने? पता लग रहा नहीं था. मेरे को फेस रीडिंग नहीं आती इसलिए पूछना पड़ता है. Online, how many of you have seen the videos of financial statements? Yes or no? Everyone has to comment. Those who don't comment will be considered they are not interested in the class also. No, yes, yes. Let me see everyone. Okay, yes. Yes, yes. They are not lying me if they are lying. They are lying to themselves. But I assume that you are not lying in my class. You lie, you have to face the consequences. I will not. Okay, most of you are saying yes, so it's a good thing. It's a good start. We'll see you tomorrow. Okay. Thank you, everyone. Thank you very much.